Fund managers are running away from silver like it personally insulted their families. And I'm sitting here this morning looking at the headlines, looking at the price action, looking at what the so-called experts are saying, and I'm thinking, wait a minute, is everyone seeing the same market I'm seeing? Because the story being told right now and the story that's actually unfolding are two very different things. I wasn't planning to make this video today. I had a whole list of other things to do. But then I saw the mining stocks moving, I saw silver bouncing, I saw the fund manager quotes coming out, and I thought, okay, fine. Someone needs to walk through this properly. Not the panic version, not the hype version, the real version. So here it is. It's a Monday, and I'm recording this with way too many browser tabs open and a cup of tea that's gone cold because I keep getting distracted by charts. Comment below and tell me what day you're watching this and where you're watching from. Are you in Asia, Europe, the Americas, somewhere else entirely? I'm genuinely curious because silver trades around the clock and I want to know where my people are tuning in from. Quick thing before we dive in. If you find this breakdown useful, if you appreciate someone actually walking through the details instead of just giving you a hot take, then subscribe and drop MRAG in the comments so the algorithm knows you're here for real analysis. It helps more than you think. And it keeps me making these videos instead of whatever else the platform wants to push. Okay? Let's talk about what just happened and why it matters way more than the headlines suggest. Silver miners are up across the board this morning. Hecla mining up 1.5% pre-market. Coeur mining up 1%. Endeavor Silver up 1.5%. Silver Corp up around 2%. The silver ETFs, both SIVR and SLV, are up over 3%, and spot silver itself is trading around $81 per ounce, up over 4% in a single session. Now, if you just read that, you might think, okay, cool, silver is having a good day. But here's the thing, silver hit $121 just weeks ago, $121. And then it collapsed. I mean, really collapsed. It crashed all the way down to $67 at one point. That's a drop of nearly 45% in a matter of weeks. And now it's bouncing. And the question everyone should be asking is simple. Is this the start of a recovery? Or is this just a dead cat bounce before the next leg down? And here's where it gets really interesting. While silver is bouncing, while the miners are green, the institutional money, the fund managers, the people who manage billions of dollars, they're saying they don't want anything to do with silver right now. Let me read you some of these quotes because I think you need to hear them directly. One fund manager said silver is like gold on steroids. It responds to the same geopolitical drivers as gold, but silver also has industrial uses linked to the energy transition and AI, and it is a less liquid market prone to eye-watering swings. Another one said they continue to favor gold over silver, with gold providing a more liquid and stable safe haven asset. And here's the one that really caught my attention. One manager said silver is not a precious metal in their view, and therefore not a compelling alternative store of value. He said it's not something they would hold in their portfolios. Not a precious metal. Think about that for a second. Silver has been considered a precious metal for literally thousands of years. It's been used as money across dozens of civilizations. And now we have fund managers in 2026 saying they don't even consider it precious. Now, let me be the adult in the room for a second. I'm not here to tell you these fund managers are wrong. They're managing real money. They have real constraints. They have clients who will ask questions if their portfolio drops 20% in a week. And silver can absolutely do that. But I am here to tell you that what's right for a fund manager with $1 billion mandate might not be what's right for you. Their constraints are not your constraints. Their time horizon is not your time horizon. And their definition of risk might be completely different from yours. So let's actually dig into what's happening here and why I think the story is more nuanced than either the panic crowd or the hype crowd wants you to believe. First, let's talk about the volatility, because this is what's scaring everyone. Silver crashed from 121 to 67. That's real. That's painful. If you bought at the top, you're down almost 50% in a matter of weeks. That's not a correction. That's a collapse. But here's what most people aren't putting in context. Silver rose 150% in 2025. 150. That's not a normal year. That's an explosive year. And when you have an explosive move up, you usually get an explosive move down at some point. It's just how markets work. One expert I was reading put it this way. Precious metals often witness 20 to 30% drawdowns after strong rallies, and the latest decline followed unusually high returns over the past year. So yes, the drawdown is painful. But it's not unprecedented given what came before it. If you made 150% and then gave back 40%, you're still up significantly from where you started. Context matters. Now here's where I want to challenge something that's floating around in a lot of the commentary right now. The narrative is that silver is too volatile to hold, that it's not a real precious metal, that fund managers are avoiding it because it's too risky. But let me ask you something. When silver was ripping higher in 2025, were these same fund managers pounding the table saying everyone should buy? When it hit $100? When it hit $115? When it hit $121? I'll tell you the answer. Some were, some weren't. But now that it's crashed, suddenly the narrative is that silver was always too risky to touch. That's what we call rear view mirror analysis. It's easy to explain why you didn't own something after it went down. It's harder to have conviction when things are moving. And here's what I find interesting. Even the fund managers who are bearish on silver right now are still acknowledging the fundamental case. One manager said he remains bullish on both gold and silver over the long term. His headline silver exposure is modest, but understates his true positioning given his significant weighting in gold producers, many of whom also produce silver as a secondary output. Another analyst expects silver to average around $45 to $50 per ounce in 2026, with year-end targets reaching $47 to $51. More bullish analysts are predicting prices closer to $100 based on continuing demand from electrification, renewable energy, and advanced manufacturing. So even the cautious crowd sees 45 to 50 as the base case, and the bullish crowd sees a potential return toward 100. That's a pretty wide range, and it tells you something. Nobody actually knows where silver is going. They're making educated guesses based on different assumptions. Now let me talk about what's actually driving silver, because this is where the story gets really interesting and most people are missing it. Silver is not just a precious metal, it's also an industrial metal. And that dual nature is exactly what makes it so volatile, but also what makes it so interesting right now. Let's start with solar. Solar panel manufacturers consumed over 25% of annual global silver supply in 2024 alone. 25%. That's 1/4 of all the silver mined in a year going into solar panels. And here's the kicker. Silver demand from the solar industry is expected to nearly double between 2020 and 2030. Nearly double. We're not talking about marginal growth here. We're talking about a massive structural increase in demand from one industry alone. Then you have electric vehicles. EV-related silver demand jumped 20% in 2025. Silver is needed for sensors, high-voltage wiring, advanced connectors, and power management systems. Every EV uses more silver than a traditional car. And EV adoption is still growing globally, despite whatever headlines you might read about slowing growth in certain markets. And then there's the new demand vector that almost nobody is talking about: AI and data centers. Data centers need silver for thermal management systems that handle extreme power loads. The amount of computing power being deployed right now for AI applications is staggering. And all of that computing power generates heat. And all of that heat needs to be managed. And silver is one of the most effective conductors we have. So you have solar demanding more silver, EVs demanding more silver, data centers demanding more silver. And this is happening while supply is constrained, because most silver is mined as a byproduct of other metals like copper and zinc and lead. You can't just decide to mine more silver. You need to find deposits. You need to build mines. You need to get permits. You need to hire workers. You need to install equipment. That takes years, sometimes decades. Meanwhile, demand is growing now, not in 10 years, now. So when fund managers tell you they're avoiding silver because of volatility, I understand their reasoning, but I also think they might be missing the bigger picture. Volatility is not the same as fundamental weakness. Sometimes the most volatile assets are volatile precisely because the fundamentals are changing faster than the market can process. Now let me talk about the mining stocks specifically, because there's something interesting happening there. The silver miners are up today. Hecla, Coeur, Endeavor, Silvercorp, they're all green. And that's despite the fact that silver just had one of the most violent corrections in recent memory. Why? Because the miners are leveraged to silver prices. When silver goes up 10%, the miners can go up 20 or 30%. When silver goes down 10%, the miners can go down 20 or 30%. They amplify the move in both directions. But here's what I find interesting. Even after the crash, even after silver dropped from 121 to 67, the miners are still finding buyers. There's still demand. There are still people willing to step in and buy these companies at these prices. That tells you something. It tells you that not everyone is running for the exits. It tells you that some investors see value here. It tells you that the narrative of universal panic might be overstated. And here's a quote from one fund manager that I think is worth paying attention to. He acknowledged that silver looks more vulnerable to a near-term pullback, but said he remains positive on the longer-term outlook. That's the nuance that gets lost in the headlines. You can be cautious about the short term and bullish about the long term at the same time. Those aren't contradictory positions. That's just realistic assessment of a volatile market. Now let me give you a framework for thinking about this because I don't want you leaving this video with just information. I want you leaving with a way to make decisions. First question, what's your time horizon? If you're trading silver over days or weeks, you need to respect the volatility. You need stops. You need position sizing. You need to be okay with being wrong because silver can move 10% in a day and it doesn't care about your opinion. If you're investing over years or decades, the daily volatility matters less. What matters is the fundamental trajectory. Is demand growing? Is supply constrained? Is the asset likely to be worth more in 10 years than it is today? Those are the questions that matter for long-term investors. Most people get in trouble because they have a long-term thesis but a short-term time horizon. They buy because they believe in the fundamentals but then panic when the price drops 20%. Don't be that person. Match your behavior to your stated time horizon. Second question, what's your allocation? One expert put it really well. The decision to buy, hold, or book profits should be based on allocation, not emotion. If metals exposure drifts away from the intended portfolio weight, investors should rebalance gradually rather than react abruptly. So if you decided that silver should be 5% of your portfolio and it's now 3% because of the crash, you might consider adding. Not because you're trying to catch a bottom, but because you're rebalancing to your target. And if you decided silver should be 5% but it ran up to 15% during the rally, you might consider trimming. Not because you're bearish, but because you're rebalancing to your target. This is how professionals think about it. They don't ask, should I buy or sell silver? They ask, is my portfolio in line with my target allocation? And if not, what adjustments should I make? Third question, what would change your mind? If you're bullish on silver, what would make you bearish? If silver breaks below 67 and keeps going, does that change your thesis? If industrial demand disappoints, does that change your thesis? If the dollar rips higher, does that change your thesis? If nothing would change your mind, you don't have a thesis. You have a religion. And religions are great for spiritual matters, but terrible for financial matters. I'll tell you what I'm watching. I'm watching the 67 level. That's the recent low. If silver holds above that on future pullbacks and starts making higher lows, that's constructive. If it breaks below 67 and keeps going, the picture gets darker. I'm also watching the 92 level on the upside. One analyst specifically called out 92.24 as a key resistance. Unless silver clears that level, he's not convinced of a medium-term uptrend. That's a reasonable technical view, and I think it's worth respecting. And I'm watching the miners. If the miners start making new lows while silver is making higher lows, that's a divergence that would concern me. If the miners confirm silver's moves in both directions, that tells me the move is real. Now let me address the elephant in the room. Should you buy the dip? And I'm going to be honest with you, I don't know. Nobody does. Anyone who tells you they know for certain is either lying or trying to sell you something. What I can tell you is that the experts are split on this question. One expert suggested using correction bands as signals. An 8 to 12% fall in gold and 15 to 20% fall in silver can justify staggered buying if allocation drops below target. A rebound that pushes exposure 2 to 3 percentage points above plan may warrant partial profit booking. So if silver drops 15 to 20% from wherever you're measuring from and your allocation is below target, that might justify adding. Not going all in, just adding gradually. Another expert warned that silver usually experiences much larger drawdowns after an extended rally than gold owing to its higher price volatility. The risk-return balance has become less favorable for silver in 2026. So you have one side saying the correction creates opportunity and another side saying the risk-reward has deteriorated. Both of these views are legitimate. Neither is obviously wrong. The question is, which framework matches your situation? If you have a long time horizon and your allocation is low, maybe the opportunity framework makes sense. If you're more tactical and you're worried about further downside, maybe the caution framework makes sense. There's no universal answer here. There's just the answer that fits your goals and your risk tolerance. Now let me zoom out for a second because I think there's a bigger story here that nobody's talking about. We're living through a moment where the demand for materials is changing faster than supply can respond. Solar needs more silver. EVs need more silver. AI needs more silver. And this is happening while silver production is constrained because it's mostly a byproduct. At the same time, we have a dollar that's weakening. We have central banks buying gold. We have geopolitical tensions creating demand for safe havens. We have inflation concerns that haven't fully gone away. Silver sits at the intersection of all of these trends. It's both an industrial metal and a monetary metal. It's both a consumption story and a fear story. It's both a supply-constrained asset and a volatile trading instrument. That complexity is what makes silver confusing, but it's also what makes silver interesting. Because when all of those trends align, you can get explosive moves. And we saw that in 2025 when silver went up 150%. The question is whether those trends continue to align or whether they start to diverge. And that's not something anyone can predict with certainty. But here's what I'll say. The industrial demand story is not going away. Solar installations are growing. EV adoption is growing. Data center construction is growing. These are multi-year mega trends, not temporary fads. So even if silver is volatile in the short term, even if it has another 20 or 30% drawdown, the fundamental demand picture remains strong. And over time, fundamentals tend to win. Now, I want to address something that's probably on your mind. You might be thinking, okay, but if the fundamentals are so strong, why did silver crash 50% from the highs? And here's my honest answer. Because markets overshoot in both directions. When sentiment is euphoric, prices run way above fundamental value. When sentiment is panicked, prices crash way below fundamental value. That's just how markets work. At 121, silver was probably ahead of itself. The fundamentals didn't support that price. Not yet anyway. So it corrected. Hard. At 67, silver was probably oversold. The fundamentals hadn't changed that dramatically. The solar panels were still being installed. The EVs were still being built. The data centers were still humming. So it bounced. The truth is probably somewhere in between. Maybe the right price is 80. Maybe it's 90. Maybe it's 70. Nobody knows for certain because price discovery is an ongoing process. But here's what I can tell you. The people who bought at 121 are hurting right now. The people who sold at 67 are probably regretting it. And the people who had a plan, who knew their allocation, who knew their time horizon, who knew what would change their mind, those people are probably sleeping okay at night. That's the difference between investing and gambling. Investors have a process. Gamblers have hopes. Now let me talk about the fund manager perspective for a second because I think there's something important to understand here. When a fund manager says they're avoiding silver because of volatility, they're not wrong. They have constraints that you don't have. They have clients who ask questions. They have boards who review performance. They have mandates that require stability. If a fund manager puts 10% of the fund into silver and silver drops 50%, that's a 5% drag on the whole portfolio. That's a lot of explaining to do at the next client meeting. But you're not a fund manager. You don't have those constraints. You can size your position appropriately. You can have a longer time horizon. You can tolerate more volatility because your job doesn't depend on quarterly performance. So when you read headlines about fund managers dumping silver, don't assume that means silver is a bad investment. It means silver is a bad investment for them given their constraints. Your constraints might be completely different. This is one of the biggest mistakes retail investors make. They assume that what's right for institutions is right for individuals. But institutions and individuals have completely different objectives, time horizons, and constraints. All right, let me give you 3 scenarios from here because I think that's the most useful way to think about this. Scenario 1, the boring scenario. Silver bounces around between 70 and 90 for the next few months. The miners trade up and down with it. Nothing dramatic happens. The volatility fades. Everyone gets bored and moves on to arguing about something else on the internet. This is actually the most likely scenario in terms of raw probability. After a dramatic move in either direction, markets usually consolidate. They digest the move. They find a new equilibrium. And then eventually something happens to push them in a new direction. In this world, you don't need to do much. If you hold silver, you hold. If you don't hold silver, you wait for clearer signals. You don't panic. You don't FOMO. You just observe. Scenario 2, the resumption scenario. The fundamentals reassert themselves. Industrial demand keeps growing. Supply stays constrained. The dollar keeps weakening. And silver starts climbing back toward the highs. In this world, the crash was just a correction within a larger bull market. The trend resumes. The people who bought the dip look smart. The people who sold the bottom look foolish. This is the scenario that silver bulls are betting on, and they might be right. The fundamental case is strong. The demand growth is real. The supply constraints are real. But timing is everything. And just because a scenario is likely eventually doesn't mean it happens tomorrow. Scenario 3, the capitulation scenario. The rally was a blow off top. The crash was just the beginning. Silver continues lower, breaking through 67 and heading toward 50 or lower. The miners get crushed. The bulls throw in the towel. Everyone says, I knew silver was too risky all along. This is the scenario that fund managers are worried about, and they have a point. Blow-off tops can be followed by extended bear markets. The gold and silver markets have seen this before. You can have years of underperformance after a speculative peak. The problem is you don't know which scenario you're in until it's already happened. That's why having a plan matters more than having a prediction. So here's my practical framework. If you already own silver, ask yourself if your position size is appropriate for your risk tolerance. If silver dropped another 30% from here, would you be okay? If the answer is no, consider reducing, not eliminating, just right-sizing. If you don't own silver but want to, consider scaling in gradually rather than going all in. Buy a little now, see what happens. Buy a little more if it drops. Buy a little more if it breaks above resistance. Don't bet everything on getting the timing right because nobody gets timing right consistently. And whatever you do, have a plan for what would change your mind. Know your levels, know your triggers, know when you'd add and when you'd reduce. Write it down, because when prices are moving fast, you won't have time to think. You'll just react. And reactions driven by emotion usually end badly. Okay, I've said a lot. Let me land this plane. Silver just had one of the most violent crashes in recent memory, 121 to 67, nearly 50%. That's real. That's painful. That demands respect. But silver is also bouncing. The miners are green. Industrial demand is strong. Solar EVs and AI are all growing. Supply is constrained. The fundamentals haven't changed. Fund managers are avoiding silver because they have constraints you don't have. That doesn't make them wrong. It also doesn't make silver a bad investment for people with different constraints. The right move from here depends on your time horizon, your allocation, and your willingness to tolerate volatility. There's no universal answer. There's just the answer that fits your situation. So here's my ask. If this breakdown helped you see through the noise, if it gave you something to think about that you weren't going to get from the usual headlines, then do me a favor. Subscribe. Drop Imster AG in the comments and share this with one person who you think needs to hear it. Also tell me this. Are you buying this dip, holding, selling, waiting? I want to know how you're thinking about this. Drop your take in the comments and tell me where you're watching from. What time zone, what country. I read these comments and I'm always amazed at how global this community is. Silver trades everywhere and I want to know where my audience is. All right, I'm going to go reheat this tea and stare at some more charts. If something major happens in the silver market, I'll be back with an update. Until then, stay sharp, stay humble, and remember that surviving volatility is more important than maximizing returns. One more thing. This is educational content based on publicly available market information and my interpretation of various reports and analyses. It is not personal financial advice. I don't know your situation, your risk tolerance, or your goals. Do your own research. Talk to a qualified professional if you need personalized guidance. And never invest money you can't afford to lose. See you in the next one.